Hi, we are now on part 3 of financial liabilities. So our topic is debt restructuring. Again, this is Mampat discussing with you the topic debt restructuring. That is to conclude our discussion of financial liabilities. So at the end of this module, learners are expected to define debt restructuring and identify its effects, distinguish the three forms of debt restructuring, account for each of the three forms of debt restructuring, and identify the required disclosures relating to debt restructuring. So what is debt restructuring? So this is a concession, meaning a favor granted by the creditor to its debtor that the former would not otherwise grant under normal conditions of the debtor. So that means that this is a favor granted by the creditor that during normal circumstances of the debtor, the creditor would not grant such favor. Therefore, the creditor is actually pushed to the wall. It has no other alternative except to grant this concession. So what are the effects of debt restructuring? So debt restructuring, from the point of view of the debtor, will result in the recognition of a financial liability. It will also result in recognition of gain in its books, and from the point of view of the creditor, an impairment loss, because that is a receivable from the point of view of the creditor, an impairment loss or simply bad debts are recorded in its books. There are three forms of debt restructuring. Asset swap, meaning a non-cash asset is given up by the debtor to settle a troubled debt. Second one is equity swap. So to settle a troubled debt, the debtor issues its own equity instruments. Therefore, the creditors will soon, or the creditor will soon become a shareholder of the entity. Then the third one is modification of debt terms, meaning a debt will be settled, a troubled debt will be settled by having another new set of debt. So modification of debt terms may be undertaken in any or combination of the following: reduction in principal, condonation of interest, extension of maturity date, or change in interest rate. So we go to the first one, asset swap. So for accounting purposes, what are our accounting procedures? We compare the carrying value of the liability settled with the carrying value of the asset surrendered. Therefore, the entry will be straightforward. We are to recognize the liability, and at the same time, we are to recognize the asset. So the carrying value of the liability settled, the difference between the carrying value of the liability settled and the carrying value of the asset surrendered is generally taken as a gain in profit or loss. Again, take note that generally the debt restructuring results in a recorded gain in the books of the debtor. So to exemplify, an overdue note payable of 10 million with interest payable of 1 million with 10% interest rate. So that is 1 million, which is the accrued interest based on 10% interest rate, is settled by transferring land with carrying amount of 9,500,000 and fair value of 9,900,000. So In debt restructuring, it is expected that the fair value of the asset that is surrendered is lower than the carrying value of the debt because the debtor is in deep financial trouble, and therefore if this fair value is more than the carrying value of the debt, then actually the problem is not one of troubled debt, but the problem is just liquidity. Therefore, the remedy, one of the remedies of the debtor would just be to sell the asset at a higher price, meaning higher than the carrying value of the debt or the fair value of the debt, and then use the proceeds to extinguish the debt. That would work still in favor of the debtor. So from the proceeds, there may be still some amount that is left. However, in troubled debt restructuring, it is almost always that the updated carrying value of the liability or the fair value of the liability is more than the fair value of the asset. Okay, so we go back to this problem. Again, the overdue note payable has a face value of 10 million. The recorded interest payable based on 10% interest rate is 1 million. And it is to be settled by transferring land with fair value of 9,900,000 and carrying amount of 9,500,000. Therefore, based on this principle that we only need to compare the carrying value of the debt to be settled and the carrying value of the asset surrendered, the difference being taken as a gain in profit or loss. So to prepare the entry, our entry is simply to debit notes payable 10 million, debit interest payable 1 million, that is to recognize the liability, credit land at its carrying amount of 9,500,000 and credit gain on settlement of debt or gain on debt restructuring amounting to 1,500,000. However, for more meaningful financial statement presentation, the carrying value of the asset may be compared with the fair value of the asset, and the difference between these two may either be a gain or loss on exchange, or if the carrying value of the asset is more than its fair value, such may indicate that there is an impairment loss. So such impairment loss will have to be recorded first. Then the difference between the fair value of the asset and the carrying value of the liability settled is recorded as gain on settlement or gain on debt restructuring. Therefore, if the company opts to present more meaningfully its statement of comprehensive income, we will revise our entries in the previous case as follows. Again, we debit notes payable 10 million, credit interest payable 1 million. The land has a carrying amount of 9,500,000, but its fair value is 9,900,000. Therefore, if we opted to sell the land, we will be recognizing gain on disposal amounting to 400,000. Therefore, we credit gain on exchange of land because this is now treated as an exchange, 400,000, and the difference between the carrying value of the debt, which is 11 million, and the fair value of the land, which is 9,900,000, is recorded as gain on debt restructuring. Therefore, if the question is how much amount is taken to profit or loss as a result of this transaction, our answer is still 1,500,000 presented in two line items. We have gain on exchange of land 400,000 and gain on debt restructuring amounting to 1,100,000. However, the total gain is still taken to profit or loss is 1,500,000. We now go to the second one, equity swap. Again, in equity swap, we issue our own equity instruments to settle a troubled debt. So we compare now three items. the difference between the carrying value of the liability settled, which is expected to be higher than the fair value of the equity instruments issued, if that is determinable. If not, we are to use the fair value of the liability settled. So the difference between the two is a gain that is taken up in profit or loss. Now, the difference between the fair value of the equity instruments issued or the fair value of the liability settled over the par value of the equity instruments issued is taken to equity in the form of share premium. Again, you compare the carrying value of the liability settled with the fair value of the equity instruments issued if determinable. Otherwise, use the fair value of the liability settled. So the difference between these two is a gain on debt restructuring that is taken to profit or loss. Now, any excess of the fair value of either the equity instruments issued or the liability settled over the par value of the equity instruments issued is taken in equity using the account title share premium. So to exemplify, again, we are going back to that overdue notes payable of 10 million with interest payable of 1 million based on 10% interest rate, which is settled by issuing 80,000 of 100 par ordinary share, which currently sell at 120 pesos per share. Okay, therefore, we are to recognize again the liability. We debit notes payable 10 million, credit interest payable 1 million. The total fair value of the shares issued is 80,000 times 120, which is 9,600,000. So 11 million minus 9,600,000, the gain on debt restructuring that is taken to profit or loss is 1,400,000. But in our equity accounts, we are crediting ordinary share equal to the legal capital, meaning the par value of the share, so 80,000 times 100, that's 8 million. We are to credit share premium for the excess of the fair value of the shares over its par, so that's 120 minus 100, so that is 20 pesos per share, times 80,000 shares issued, so total share premium credited is 1,600,000. So again, to complete our entry, we debit notes payable 10 million, debit interest payable 1 million, credit ordinary share 8 million, credit share premium for the excess of the fair value of the shares over its par value, 1,600,000, and credit gain on debt restructuring, which is equal to the excess of the carrying value of the debt over the fair value of the shares issued. So in this case, that's 1,400,000. We proceed now to the third form of debt restructuring, and that is modification of debt terms. In modification of debt terms, you compare two items, the carrying value of the liability settled, which we will call in this case as amount A. This will be compared with the present value of modified cash outflow. We call it amount B, and amount B will be computed using as discount rate the original discount rate. So if the difference, if the excess, again, it is expected that the carrying value of the liability settled will be more than the present value of the modified cash outflow because there is a concession granted by the creditor. Any difference between the two will have to be tested for the 10% threshold. What does it mean? If the difference between the two is at least 10% of the carrying value of the liability settled, then this is considered to be substantial modification. Again, if the difference between these two and A is expected to be more than B. So any excess of A over B, if it is at least 10%, then that is considered to be substantial modification. So what's the accounting treatment for substantial modification of debt terms? You are to recognize the old liability. So the old liability will have to be canceled, and you have to recognize the new. Therefore, this will apply the initial recognition principles. The difference between the carrying value of the old liability and the initial measurement basis for the new liability will be taken as a gain in profit or loss. So let us take up this case. ABC has overdue notes payable of 10 million with interest payable of 1 million, sorry for that. Based on 10% interest rate, it negotiated with its creditor for modification of debt terms as follows. Condonation of the accrued interest, and then equal periodic payment of 2,500,000 for the next 4 years. No further interest is to be charged by the creditor. Therefore, we compare A. A is the carrying value of the note, and the carrying value of the note is its principal of 10 million plus the accrued interest payable of 1 million. So total is 11 million. Then compute for the present value of modified cash flow that is based on 10% original interest rate. Therefore, the present value of ordinary annuity discounted at 10% for 4 periods is 3.1699. We are using present value of ordinary annuity because the debtor, ABC Company, will make 4 equal periodic payments during the next 4 years. So the present value of modified cash outflow is 7,924,750. So that we have a difference of 3,075,250, and obviously 3,075,250 is more than the 10% threshold. Therefore, it passes the 10% threshold. Hence, this transaction would qualify as substantial modification. So in substantial modification, the principle is you are to recognize the old liability and we are to recognize the new. And in recognizing the new, you are to apply the initial recognition principle that the liability will be recognized using or based on its present value, and the present value will be computed based on the market rate of interest at the date the liability is initially recognized, and market rate of interest for similar notes at this time is 8%. Therefore, 2,500,000 will now be discounted. The 4 payments of 2,500,000 will have to be discounted for 4 periods at the market rate of interest at the date this liability is incurred. So that is at 8%. So it is 8,280,250. Therefore, the 10% discount rate is used only to determine the difference between the carrying value of the old liability and the present value of the modified cash flow to determine whether this transaction will qualify under the 10% threshold. But after that, you will not be using the original effective interest rate anymore, because what will be used in the recognition of the new liability will be the new effective rate. And the new effective rate of the new liability will be the market rate of similar notes, which in this case is 8%. Therefore, to record the debt restructuring, we debit notes payable 10 million, debit interest payable 1 million, credit notes payable, that is 2,500,000 times 4, it's 10 million. The difference between face of 10 million and its present value, discounted at 8% of 8,280,250, will be recorded as discount on restructured notes. So please change this to distinguish the old note from the new note. So this is discount on restructured notes payable. So debit discount on restructured notes payable, 2,719,750. 2,719,750. Therefore, our gain on debt restructuring is now increased to 3,719,750. So we are not recording this gain equal to this difference, but the gain is the difference between the carrying value of the old debt and the present value of the new debt. Its present value being determined based on the new effective interest rate. What if the difference does not pass the 10% threshold? Okay, so if the difference between these two, so if the excess of the carrying value of the liability settled over the present value of modified cash outflow does not reach at least 10%, then it is considered that there is no substantial modification, in which case the carrying value of the liability is maintained in the record. No entry therefore is necessary at the date of restructuring, or you may just transfer the old liability or the modified liability, but the carrying value will still be the same. However, because there is modified cash outflow, we will be computing for a new effective rate. So to exemplify, ABC has overdue notes payable, so the same scenario, 10 million with interest payable of 1 million based on 10% original interest rate. It negotiated with its creditor for modification of debt terms as follows: equal periodic payment of 3,200,000 for the next 4 years, and the market rate of interest for similar notes is 8%. Therefore, the carrying value of the note is 11 million, whereas the present value of the modified cash outflow is 3,200,000 times 3.1699, is still using the 10% interest rate for purposes of determining the difference between A and B, and therefore that's 10,143,680. The difference is just 856,320. So 856,320 is less than 1,100,000, which is 10% of 11 million. And therefore, this is not considered as a substantial modification. So if this is not a substantial modification, then we may opt not to prepare an entry, or you may prepare an entry just transferring our liability to the new modified liability, but the carrying value is still the same. So if we opt for an entry, so an entry may not be necessary, but if we opt for an entry just to signal that there is a debt restructuring, then our entry is to debit notes payable old 10 million, debit interest payable 1 million, credit notes payable equal to 3,200,000 times 4. So that's 12,800,000. and to bring 12,800,000 to its carrying value, which is still 11 million, then our balancing figure must be a debit, so that is debited to discount on notes payable 1,800,000. So you may also distinguish the two notes payable such that you may debit here notes payable and credit here restructured notes payable, such that your discount here is discount on restructured notes payable. Therefore, based on carrying value of 11 million and modified cash outflow of 3,200,000, we have to compute for a new interest rate. And your factor now will be computed as follows. The present value factor, which you will have to find in the present value table, will be computed as follows. This is 11 million, which is considered to be the carrying value of the liability over the equal periodic payment of 3,200,000 over the next 4 years. Hence, our PV factor is 3.4375. So, in the present value table of ordinary annuity, going to line 4, coinciding with the number of years or number of times in which you are to pay 3,200,000, this factor is between 6% and 7%. Hence, interpolation will have to be made. But this is not mathematics of investment, so you may compute for that using your Excel worksheet. Hence, the discount on notes payable will be gradually transferred through an amortization table to interest expense in the future. Okay, so what are to be disclosed in the notes to financial statements when the company resorted to debt restructuring? So the following items will have to be discussed concisely in the notes to the financial statements. The nature of the liability canceled, as well as the account titles canceled. The material terms and conditions of the new debt, if we incur a new debt under form number 3. If assets were pledged for restructured debt, then the assets pledged. The new interest rate, then material items of income and expenses in the statement of comprehensive income, and these are generally interest expense incurred on the liability and the gain on debt restructuring, both taken to a statement of comprehensive income. And because we underwent debt restructuring, you have to describe the nature of remediations made to settle your troubled debt. Okay, again in this module, it is expected that you are able to define debt restructuring and identify its effects, distinguish the 3 forms of debt restructuring, record each of the 3 forms of debt restructuring, and identify required disclosures related to debt restructuring. Okay, so that is the last topic under financial liabilities, and therefore we will go back to your textbook and answer the required exercises. Goodbye for now. See you in our synchronous